Hello, my name is Ken Eades, and I'm the Academic Director of the Center for Asset Management here at the Darden School of Business at the University of Virginia. We're putting on our 6th University of Virginia Investing Conference today and tomorrow. And we have with us Jason Trennert. Jason is a Managing Partner and a Chief Investment Strategist at Strategist Research Partners. And Jason, we're going to have you on the stage in just a few minutes, but before we do that, when I think of strategists, I think about a macro analysis where they think about policy and all the markets coming together. But ultimately, people want to know what sort of decisions do I need to make if I'm a practicing asset manager. And so that's the question. Where do they put their money? And you have a theory here. You think about this. I've heard this T.I.N.A. So what's this
T.I.N.A.
about?
Yeah. So actually, T.I.N.A. was something. It was a nickname that was given to Margaret Thatcher because she used to say there is no alternative all the time, and she said that in response to the Keynesians and her pro-market approaches to liberalizing the British economy. I think we think equities in many ways are the T.I.N.A. asset class, which is to say that there is no alternative in an era of financial repression in which the central banks are buying an enormous amount of the issuance. It's hard to get real returns, positive real returns above the rate of inflation in other asset classes other than equities. And I think that's a big part of the big performance that you've seen this year. And to be quite honest, I think it's probably going to continue longer than people think.
So this is the last asset class left standing? How do you think about it?
Really, so if you look at just the amount of risk that people have to take in order to get, again, returns above the rate of inflation, it really is one of the last standing. So if you take a look just here at home in the U.S., you have inflation that might be, let's just use round terms, about 1.5, and you have to lend the government money at 270 for 10 years. That just doesn't seem like the best use of capital when you can buy the common stock of Johnson & Johnson, let's say, and get a 4% yield.
And we're seeing a lot of these yields where the companies are repurchasing shares or paying dividends, and so you start to get an attractiveness just based on a yield, which who would have thought that would be attractive relative to fixed income?
Well, Ken, it's a funny thing because since 1926, half of the return from equities has actually come from dividends. It's just we forgot that when you had really discriminatory tax treatment.
That's a good reminder.
Yeah, discriminatory tax treatment of dividends, and certainly the 90s with the growth of tech don't pay dividends. People tended to forget that, but it's still a very important part of yield. And my own view, dividends are going to be a big part of the total return of stocks in the future. You're not going to have, 27% type numbers like you're having this year after year. Dividends are going to make up a bigger part of the return.
Okay, so what are you going to tell me next year? And here's what I'm thinking. I know you don't know what you're going to tell me next year. But we've got a lot of ingredients here that make you worry about a bubble.
Yeah.
Right? Because if everybody agrees with you, and the money starts migrating into, equities, there's only so much pressure that can take. Do we have the ingredients for a bubble? How do you feel about the levels of the stock?
Well, listen, I think there's more of a case to be made that there's a bubble in fixed income, bond market mutual funds. You've seen the flows have greatly exceeded the flows into equity funds thus far. Yeah. I also think, candidly, and I might get myself into trouble, but I think private equity is another place where there, especially in the pension endowment foundation world, there's probably more money chasing bad ideas in that market than there is in the public markets these days. You do have the ingredients for a bubble. I'm just not sure. St. Augustine said, "Make me chase, just not yet." And I have a feeling that's my attitude towards the market because I think market's probably going to continue to go up for a while.
Well, we have a panel on endowments at the conference this year. It'll be interesting if this topic comes up. You were with us 2 years ago, and we appreciate that, and we appreciate that you've come back. And thanks again for coming to Charlottesville.
It's such an honor to be here. Thank you.